Welcome, David. Would you like to take a moment and just introduce yourself to our audience today?
Hi, Linda. My name's David Lipschitz. I've been running Logic Finance for the last 15 years. I specialise predominantly in commercial finance and these days predominantly in development finance as well.
What are the important factors when borrowing for development?
Well, it's a good question because a lot of people, they're like looking to commence a development, just think it's just the same as a home loan. Well, it's very different because often if you can borrow up to 3 lots, it's similar to a home loan, but really it's different in that it could very easily become a commercial loan. And generally over 3 lots, or some lenders over 4 lots, becomes a commercial loan, and then you sort of have to look at it like a business. You do a proper feasibility. I'm sure Peter's talked about that, where you have to see that there's a bottom line and you can make a profit, and then start looking at all the various metrics that the bank looks at. Hard costs value, the end value, and then if it's a commercial loan, banks even go one step further, which they would never would in a home loan situation, where they look at, well, what's your experience? Have you done this before? If you haven't, that's generally a big cross next to you. And the same with a builder. Has the builder done this before? Or are you a owner builder or developer builder? These are all questions that need to be answered when looking to go into a development.
So what would be the key points that you would go to a mortgage broker rather than just going straight to the bank?
Well, I guess suffice to say there's bankers and bankers, just like there are mortgage brokers and mortgage brokers or advisors. The key difference is that unlike a standard home loan where, so long as you can service the loan, you get the same interest rate and you get the loan, much like a normal home loan. With development finance, it's about putting forward a case, particularly if it's a commercial loan. You have to mitigate a lot of the key risks the bank sees, and that's where it's very important to have an advisor, just like you have an advisor for tax as being an accountant, or an advisor for law being a lawyer. You have an advisor for finance being a finance advisor or a commercial broker. But it's very important to note that there are commercial brokers that deal with this, and there are home loan brokers that probably don't do a lot of work with developments. So there is a key difference.
Mm-hmm. So how would borrowing for an investment be different from borrowing for a development?
Well, I guess in many ways, and I guess it depends on if the development, the aim of the development. If the development is there to keep, then there are some similarities, but certainly if the aim is to build and to sell, or at least to sell a large proportion of the development, it's almost like a standalone business. That it needs to sort of wash its own face. That's the sort of term that bankers use, or wipe its own nose. I guess the key thing is that it needs to be able to stand alone. So it shouldn't have to rely on other income to be able to service the loan. So often you actually add the interest into the loan. Often it's fairly short term, so it's a short term loan and then working out what you're going to do afterwards. And often there's different interest rates for during the construction afterwards. But also, I guess the key difference between a normal home loan and a development loan is that it attracts construction risk. And for those that have been involved with developments before know exactly what that is. There is a risk when it comes to construction, and how do you mitigate that risk? So things like, for example, including a contingency fund for that is really important. Things like including all the expenses. For example, if there was going to be a quantity surveyor for each of the stages, incorporating all of that in there. These are all important things to incorporate, just as you would with any business. You incorporate all the fees, make sure you've still got a profit margin at the bottom. And in fact, some lenders who will remain nameless, generally require a minimum profit margin to even do the deal in the first place. They generally require a minimum 15% return for them to even approve such a deal. If that makes sense.
Yeah. So what sort of deposit would be required for a development, in particular Peter's project at 196 Esplanade?
So let's talk about Peter's project. Really interesting project, great project. The interesting thing about this one is that despite it being Torrens title, there are a number of adjoining walls. So really the way lenders would look at a project like this is that you would have to build them to actually realise the value, and often you'd have to build them all together. right? So there are many developments out there where you can compare what the margin you're going to make on just selling the land versus the margin you're going to make on, doing the construction, noting full well there's an additional risk with the construction, so you're expecting to make a greater margin there. In this instance, really, for Peter to realize the value in the project, he needed to construct it himself, right? So that's the first thing to bear in mind. Second thing is, it depends on the valuations, So Peter's lucky that this is a Torrens title, but certainly if it was a community title, the actual as-is value, so they look at the value of what the land is right now, they would hold that back a fair bit, because that's how we'd have to realize the value. With being a Torrens title, they've given a little bit to that. But generally, Peter would have had to put in, probably at least a few $100,000 up front to buy that site. And generally, all the contribution you make is up front to buy the site, so that he's got enough equity in the land to be able to do all the rest. Does that make sense? Mm-hmm. And I'll just put it out there. If you went sort of best practice, so certainly the really seasoned developers out there, the best practice is to really buy that land with cash or with equity from elsewhere, so you've got that land freehold. And if you've got a land freehold, then you're going to have enough equity to develop it, as a rule of thumb. If that makes sense. Mm-hmm. But certainly this is a great project. It's got a great return. It's always just an issue of battling with valuers these days, because the lenders lend against what the valuation would be, the as is, or the hard cost, so they put the land plus what the actual cost of developing it is, versus the land or the value of completion, what the gross realized value would be at the end. And valuers these days are so conservative, so it's a matter of finding good valuers that are prepared to value it at the market rate. And I know that seasoned developers like Peter would know such valuers like that, and that's the other benefit of doing a commercial deal, is that often you've got a little more liberty with choosing your value. When it's just a standard residential deal, you're very limited, and they'll just choose whichever value is on the panel. And this guy he's getting paid very little to these valuations, so as a rule of thumb, guess what? They're going to be conservative. Because they need to watch out for their PI and so forth. But forgive me for being cynical.
I think it's great that Peter's obviously put together such a really good, strong team to be able to put this entire project together.
Yes.
In your opinion, what would be the likely interest rate for the loan?
Okay, so as mentioned, because this is 3 lots, you could do it as a residential loan. And so long as you can, and the other good thing is, because residential, you can borrow right up to 80%. If it's commercial, you borrow up to 65%. So you can borrow more, and it's cheaper, and it's far less fees, which is great as well. So, as a rule of thumb, you can be getting investment rates these days in the 4s, in the low 4% of sorts, as is the case in the lending environment right now. Interest-only loans are more expensive than principal and interest loans, but that's okay. I mean, the bottom line is, depending on if Peter is going to be keeping them or not keeping them, an interest-only period just during the construction period is certainly the advised option. And the other thing to consider is that people get caught up on, I'm going to pay 0.5% more for this or 0.5% more for that. The reality is, it's going to be in progress claim. So really, the majority, the largest progress claim is generally the last progress claim, right? So if someone wants to work out what the interest they're going to be paying for 12 months, you generally work it out on the construction and then you halve it, because it's really only half the interest rate. So instead of 4.5, it might only be, 2.25, right? Because you're only using half of it because it's coming in progress claims throughout that period. Does that make sense? Yeah. So what does that mean? Well, it means that you shouldn't get too caught up in that 0.5%, caught up more in, what are you going to be able to do? The other thing to bear in mind is there are interest rates and there are interest rates. So there's like commercial loans out there where they go, we're going to get it to you for 5%, which is great. You go, 5% is fabulous. But what they don't tell you is that part of that 5% is a 2% line fee. So what does a 2% line fee mean? Well, it means it's 2% on the entire limit from day one, and you haven't even drawn $1. So there's the catch. So instead of 5%, the real percentage is actually higher. So it's worth, again, back to your question about whether you should get a finance advisor or not, they should be able to give you the advice on, what are you really paying and all the other fees that are involved as well. Does that make sense?
Yeah, definitely. Well, it's great to know and hear what you've got to say about this, and I really appreciate your time and coming in today. So thanks again, David. It's been great.
Great. Thank you for the invite.